Hey guys, welcome back to another episode. So today we're going to be talking about REITs, right? Real estate investment trusts, right? What are they? Why would people invest in them? What types there are, and a couple different pros, cons. Try to give you some of the basics you need to know about REITs if you're looking into them, right? So, first off, what are REITs, right? Like I said, real estate investment trusts, right? And they allow individuals to invest in large scale income producing real estate, right? So a REIT is a company that owns and typically operates income producing real estate or related assets, right? These may include office buildings, shopping malls, apartments, hotels, resorts, or self storage facilities, warehouse, and mortgages or loans, right? Unlike other real estate companies, a REIT does not develop real estate properties to resell them. Instead, a REIT buys and develops properties primarily to operate them as part of its own investment portfolio. Okay? So, why would somebody invest in a REIT, right? You're looking into them, you're thinking maybe I'm going to invest in it. So, why should you, right? Well, REITs provide a way for individual investors to earn a share of the income produced through commercial real estate ownership without actually having to go out and buy commercial real estate, right? So, what types of REITs are there? Well, there's a lot. Many REITs are registered with the SEC and are publicly traded on a stock exchange, right? These are known as publicly traded REITs. Others may be registered with the SEC but are not publicly traded. These are known as non-traded REITs, also known as non-exchange traded REITs, right? This is one of the most important distinctions among the various kinds of REITs. Uh, Before investing in a REIT, you should understand whether or not it's publicly traded and how this could affect the benefits and risks to you as the investor, right? So, what are the benefits and risks of REITs, right? So, REITs offer a way to include real estate in your investment portfolio. Additionally, some REITs may offer higher dividend yields than some other investments, but there are some risks, right? Especially with we talked about non-exchange traded REITs earlier. Like, there's, those predominantly have more risks than the other ones, right? Uh, because, right, they don't trade on a stock exchange, right? Like that's why you need to make that distinction, right? More risk involved there, right? So, lack of liquidity. Non-traded REITs are illiquid investments. They generally cannot be sold readily on the open market. If you need to sell an asset to raise money quickly, you may not be able to do so with shares of a non-traded REIT. Share value transparency. While the market price of a publicly traded REIT is readily accessible, it can be difficult to determine the value of a share of a non traded REIT. Non traded REITs typically do not provide an estimate of their value per share until about a year and a half after their offering closes. Uh, you know, and this may be years after you've made your investment, right? As a result, for a significant time period, you may be unable to assess the value of your non traded REIT investment and its volatility. Distributions may be paid from offering proceeds and borrowing, right? So, investors may be attracted to non trading REITs by the relatively high dividend yields compared to those of publicly traded REITs. Unlike publicly traded REITs, however, non traded REITs frequently pay distributions in excess of their funds from operations. To do so, they may use offering proceeds and borrowings. This practice, which is typically not used by publicly traded REITs, reduces the value of the shares and the cash available to the company to purchase more assets. So then the next one's going to be conflicts of interest, right? Non traded REITs typically have an external manager instead of their own employees. That can lead to potential conflicts of interest with shareholders. Let's take an example. The REIT may pay the external manager significant fees based on the amount of property acquisitions and assets under management. These fee incentives may not necessarily align with the interest of shareholders, right? So now we're going to talk about how to buy and sell REITs, okay? So you can invest in a publicly traded REIT, which is listed on a major stock exchange, by purchasing shares through a broker. You can purchase shares of a non traded REIT through a broker that participates in the non traded REIT's offering. You can also purchase shares in a REIT mutual fund or a REIT exchange traded fund or a REIT ETF, right? We talked about ETFs in a previous episode. If you guys want to go watch that and get to the basics of that, the last thing we're going to talk about is understanding fees and taxes, right? Publicly traded REITs can be purchased through a broker. Generally, you can purchase the common stock, preferred stock, or debt security of a publicly traded REIT. And when you do that, there's going to be brokerage fees that apply, so just be aware of that. Non-traded REITs are typically sold by a broker or financial advisor. Non-traded REITs generally have high upfront fees. Sales commissions and upfront offering fees usually total about, we'll say, roughly 10% of the investment, right? These costs are going to lower the value of the investment by a significant amount, right? Just think, for every $1,000 you put in, you instantly lose $100. So you think if we'll just say, let's say you could invest $1,000 a month, right? Essentially, you're gonna lose out on $1,200, right? So you think if you're doing $1,000 a month, you lose out on $1,200. That's an extra month of investing in that company, had you not had to pay those commissions and upfront fees, right? So the last thing we're going to talk about is going to be special tax considerations, right? Most REITs pay out about 100% of their taxable income to their shareholders. The shareholders of a REIT are responsible for paying taxes on the dividends and any capital gains they receive in connection with their investment in that REIT. Dividends paid by REITs generally are treated as ordinary income and are not entitled to the reduced tax rates on other types of corporate dividends. So if you're gonna invest in REITs, there's a good chance you should, consider consulting like a tax advisor, before you get into it, or if you're already invested into them, when it comes time to do your taxes, like pay close attention to what's going on there, right? I am invested in a couple REITs. I think at the moment I'm invested in two or three, and they're nice, but again, you really got to watch. Make sure, like I made sure all mine are publicly traded REITs. I made sure to understand how my taxes were going to work for them, so that and of course it's not for me. It's not a lot. I don't have millions of dollars in the stock market or investments or anything like that. But just being aware so that if anything happens, you can be like, oh, okay, so take this gain, take this loss, anything you need to do, right? Just be aware. If you're not sure, consult somebody, right? Hopefully, you guys got a good understanding of what's going on with REITs and whether or not you want to invest in them or not. And I really appreciate you guys watching. If you guys go ahead and give this video a like, and if you're not subscribed, go ahead and subscribe down below. Until I see y'all in the next video, y'all be safe.